Hey traders, Mike Sir here. Welcome back to my channel. Now I've gotten a lot of great responses from all of you in regards to my past video, Trading in the Zone, where I shared the top 5 things that I learned from reading Mark Douglas's book. As I mentioned, there are so many valuable lessons that you can take away from the book. So in this video, I'm going to share 5 more things that I think are important to mastering the trader mindset. And in addition, I've added a few of my own personal thoughts. Let's get started. Many people think the stock market is a casino and that making money from the stock market is based on pure luck. But how come there are successful traders who are able to consistently pull profits from this so-called casino? Now, I mentioned in my past video, successful traders think in terms of probabilities, and in addition, they have specific rules that they follow or rules that they don't break. That has helped them avoid catastrophic damage to their psyche and trading account. For example, let's just say that you believe in a so-called company stock and you buy it because you think it's going to be the next Tesla or Microsoft. Now you know it's a little bit risky because the company has some unproven technology. So you say to yourself, I'm going to put a little bit of money into this, and if it doesn't go up in value, then I'll get out with a small loss. However, the price goes down immediately after you buy it and reaches your stop loss price, but you don't sell it. You say to yourself the price drop is just temporary because other traders are just trying to scare you out of the position, and you strongly believe that the price will go back up. In fact, you believe in the long-term potential of the company that you buy even more, thinking that you're buying it at a bargain basement price. The price keeps falling, and at this point you are down more than 50%. You start panicking, your mind is filled with so much fear and emotion that you don't care whether you make money from this trade and just hope that the price will go back up to break even. Unfortunately, the trade never goes back to where you bought it at, and in fact, the company actually goes bankrupt. You lose all your money and you say to yourself you'll never ever trade again. As you can see, you as a trader can't just wing a trade and hope that you can make money based on your beliefs about a company's stock. You need to have rules in place to protect yourself in case something doesn't go according to plan. And sometimes it's as simple as being comfortable with the amount of capital that you're risking and keeping your losses small. But the challenge is you got into trading for the main reason it gives you the ultimate freedom. You don't have a boss or policies or procedures to follow like you do at work, and this can be a detriment to your trading because you have no structure or rules to follow. Simple rules such as what price to buy, what price to sell when you're wrong, and what price to take your profits. In my opinion, it's not talked about enough, but trading has the potential to do enormous damage to ourselves. It's not just the risk of losing all your money, but your confidence in yourself, and this is what I'll talk about next. Many people are motivated to trade for many different reasons, whether it's the action of pressing buy and sell buttons that makes trading feel exciting, or the thrill and euphoria that you get when a trade goes in your favor, or more likely that you watch the successful trader like BNF make hundreds of millions of dollars and you think you are the next BNF. You see, many newbie traders are at their peak confidence levels prior to entering their first trade, or for experienced traders after a big profit that they had made. After that, confidence levels slowly dissipate due to losses or disappear, especially after a big loss. So the question that I want to ask you is, how can you maintain confidence in yourself when you keep losing money on your trades and see your trading balance keep declining in value? Well, you can blame the markets, but as I said in my past video, you have to take responsibility for your trades no matter whether you win or lose. Now, it's not easy being in a profession where success is judged by how much money you make rather than your trading knowledge or even your trading skills. For example, let's just say a Bitcoin trader who became a millionaire when he or she bought Bitcoin at, let's just say, $1,000 and sold it at $60,000. Now, they can be considered a financial genius versus an experienced trader who has been steadily making money in the financial markets for over 10 years. So let me share with you a thought about confidence. Now, I don't get overly confident in myself if I make a profit on a trade where the price skyrocketed in value due to some unexpected positive news. Now, I'm happy, but I just know that I just got lucky. Or another situation where I lost money on a stock where the price fell sharply due to some unforeseen circumstances. Now, I'm not happy, but I wouldn't feel less confident in my trading abilities. The fact is that if you want to maintain confidence in yourself as a trader, you shouldn't judge yourself based purely on whether you made a profit on a trade or not, but whether you follow the rules and plans accordingly, and that you made your best judgment on the trade based on the information that you had at the time. Now, once you're comfortable with that, your confidence should neither increase nor decrease due to the outcome of any trade. One of the reasons that has attracted me to trading over 21 years ago was not just the ability to make a lot of money, but rather the fact that I could click some buy and sell buttons on my computer and I could potentially make a good living just like that. And I've always thought that in order to make a lot of money in a job, you just have to work hard, work long hours, or suck up to your boss. But here I was presented with an opportunity where the stocks that I bought would go up every single day. And this was during the dot-com days in 1999, kind of like the crypto market in the past 2 years. Everything seemed so easy. Unfortunately, I realized too late when the 2000 crash crushed me and taught me a very, very valuable lesson about the importance of discipline. Now, as you know, the act of trading is very, very easy. You press the buy button and then you press the sell button, or vice versa. It's the what price you buy at or what price you should sell at that's most important, or how much to buy or when to buy. And this is where defined rules come into play, as I talked about earlier. But what if you wrote down all your rules on what chart patterns to look for, what prices to buy in at, and did all your research on a specific stock or sector, and you didn't follow those rules? It's kind of like, you shouldn't eat junk food and you should eat more healthy foods, but you drive by McDonald's and you smell the greasy burgers and fries, and the next thing you know, you're wolfing down a burger. Now, why is that? It's a lack of self-discipline. Now, you're acting on your desires rather than logic. It's the same in trading. You shouldn't trade when there is an upcoming news event, but your friend, let's just say, bought a nice sports car yesterday and you have the intense desire to buy that same car. Now, when your desires are so strong, your logic will be low, which can lead to irrational trading decisions. It's the same wherein traders overtrade, hoping that if they trade more, they can make money quicker to satisfy desires of financial freedom immediately instead of taking many years. Now, in my opinion, to make balanced choices, there's no need to suppress your desires, but to acknowledge your desires. Now, having desires drives us or motivates us to achieve our financial goals. What you should also do is pay attention to your feelings and recognize how those desires may distort your thinking and influence your trading behavior. Raise your logical mind and decrease your emotional reactivity by outlining a detailed plan and step-by-step process on how you can achieve your desires. Now, seeing the facts on paper can help you think more rationally about your options and prevent your desires from getting the best of you. There are two emotions that hurt us as traders. One is the fear of losing money when we exit a profitable position too early because we believe that if we don't exit, we will lose money. The other is greed when we blindly put all our money into one stock, thinking that we will become rich from it. These two emotions blinds any trader from making rational decisions based on what the markets are telling them. Now, this is what we call perceptual blindness, and this happens all the time in trading. For example, let's take a look at this chart. And let's just say you bought this stock at $48. Now, even though the stock price has risen a lot already, you think it can go higher. But it falls sharply and it keeps falling to $24 per share. Now, you just lost half of your money and you're in a state of fear and panic. You don't know what to do. You're asking yourself, should you sell now so you don't lose all your money, or should you just keep holding and hoping that the price will go back up? Or ultimately, you decide to keep holding the stock because the fear and especially pain of losing half of your money is just too great for you to swallow. A few months later, the stock price continues to fall and it's now at $12 per share. It has fallen another 50% from $24, and you're now down more than 75%. Now, you've asked any trader who isn't in the stock to tell you what the price trend of this stock is. They would tell you it's down and there's no sign of it going higher. It's pretty clear, right? But because you're blinded by fear and the fact that you're down 50%, you can only think of hope. Now, the hope is that the price will go back up so you don't have to endure this pain and fear. But what I want you to do is look at and take a step back and state the obvious that the stock price is clearly not going any higher, so you must sell. Now, let me give you another thought to think of. Now, let's just say you did sell for a 50% loss at $24, but you decide to short the stock, meaning to bet on the further price decline, and at the current price of $12, you would have made a 50% return, thus making back your earlier 50% loss. Now, obviously, it's hard to say whether the price will go further down, but without a state of fear or greed, did we not state the obvious that the price trend is down? Have you sometimes wondered why the stock market moves up or down in an illogical manner, where you can't understand why a stock's price would move up when the company's fundamentals are terrible, or why a profitable, stable company is unloved by investors? Well, let me explain by sharing with you how traders think. Now, every trader in the markets wants to make a profit, right? So there are two things that they can do. One is they buy at a specific price and hope that they can sell it at a higher price in the near future. The second is they short sell by selling at a high price and hope that they can buy back at a lower price in the future. So you can see that all the price movements in the markets is merely a function of what individual traders believe about what is high and what is low. It has nothing to do with the fundamentals of a company or how the economy is doing. And if you trade based purely on this belief, then you will lose money. It's the traders who are moving the markets up or down, and you need to understand what the overall traders are thinking. Now let me show you an example and show you a chart of Tesla. And this is based on a past video that I did where I said that if Tesla broke its all-time high price, then it would go even higher. Well, it went from $900 to $1,240, an over 37% move in just 10 trading days. Now, did Tesla's fundamentals change within that 10 days? Well, probably not. Now, did investors and traders' perception of Tesla change in 10 days? Well, probably. You see, a stock's price goes up if a trader buys it, believing that he or she can sell it at a higher price at some point in the future. It's as simple as that. If you enjoyed this video, smash that like button and comment below on your thoughts. You can click also on the left-hand side to watch part 1. Also, I'm contemplating whether I should do part 3, as I think there's so much more that I can share from Mark's book. So please comment below if you want to watch part 3. I'll see you guys on the next video.